in his office. So
Very
I don't
nice.
know how to fix this. Anyway, you'll have to.
And so we'll demystify option trading and even go log in and try to buy some options. So much more, we'll get into it, practically speaking. And then we'll talk about if I have, how do I make money? How do I select the best stock to buy? Or how do you do the research? So I'll show you that as well. And if you only have $100, $1,000, $100,000, how do you get started? So this is a topic I'm planning to cover. But like I said, any topic could be covered, and you can add that in the chat window. Bhai, uski bhi baat kar lo. We'll talk about that too. So we'll add that as well on the list, because all that could be covered. There's not a problem. So look forward to interactions from you guys. So let's get started. First of all, let's realize that there are many places you can invest your money. It's not always stock. Stocks, we understand, stock is a fractional ownership in a company, but we also have bonds. Some of you wonder, like, bond, what the heck is a bond? Bond is basically a loan which is taken by a company or a government. Because suppose you want to build a school, city of Cupertino, that talks about 10, maybe hundreds of millions of dollars. You don't have that one sitting around in the treasury. So you issue a bond. So your bond is basically a loan, a fancy word for loan. Of course, you can buy in real estate. But you say, I hate tenants and all the problem, and then maja dete hain. Well, turns out there are many ways to buy real estate. It doesn't have to be a tenant. You don't have to buy an apartment building or a house. There are other ways to buy. We'll discuss that. What about commodities like gold and things like corn and metals, and there are all kinds of commodities that could be purchased. And of course, high yield savings account, which can pay better than your 0.5% you normally get. So you have multiple choices, and this is a link here on the bottom right, which I can email you this presentation, and you can learn more about different way to invest in different things. So let's take a look at picture. What is a stock market? So stock market is basically a collection of all the companies which are publicly traded, which means government has allowed them stock to be sold to public, and it goes up and it goes down. And why does it go up and why does it come down? So answer is, there are many factors. Is a supply and demand, because stock price is basically, there's an auction happens, and a willing buyer and willing seller, when they agree, that becomes a stock price of that share. So in olden days, literally in New York Stock Exchange, people will be in the pit, they'll be sort of yelling, I have 100 shares of Apple, $120, 120, anybody, 120, nobody, okay, 119. Acha yaar, 118, 118, 118, nahi 115, yaar, koi to le le. You'll keep dropping till somebody can say, okay, I'll take 50 shares at 111. That became the next stock price. People literally used to shout all day long like this. Now it's done electronically, but it was really an auction. So stock price goes up and down based on how people feel about it. So Nabil, yes, I am recording the session. So this means is that stock price goes up and down, but if you look at big picture, it has done better than most other investment styles. Just look at last 2 years. We had a huge downturn crash around 2018, but then it recovered, and now we're hitting even higher point. The point is not to get freaked out by up and down, but look at the bigger picture, which I'm hoping to show you. So I think we will mute other people who are not speaking, so that we don't have, and that will be okay. So Asan, you may have to mute yourself. Okay, and now that we can mute, actually, here let's take a look at long term. Does it pay off long term? Here I'm showing you the stock market return from 1926 till now. That's a pretty long time. And $1 invested, as you can see, can become $4,600 over the period of time. So this is a pretty impressive with all the ups and downs, all the market crashes. This has done pretty well. And so point is, look at even 1929 crash, big crash, but then again, after a few years later, it recovered and has consistently gone down. 1960, late में ये था, 73 का crash था, 80 का crash था. In the big picture, they all sort of like happened and went away, and at the end of the day, we recovered. So you cannot be afraid of stock market, especially if your horizon is long. So let's take a look at where to invest, because we mentioned there are several things. There are index fund, ETF, stocks, mutual fund. What is the difference? What are these things mean? So stock market, you understand, you have a fraction of a share of a company's fractional ownership of a company. Now, indices, which are also available, which I'll describe in a few seconds. ETF is exchange traded fund. So imagine, suppose you wanted to buy some shares. Now you don't have that much money, but what if I took $100 from one of you guys, $10 from another guy, $1,000 from another guy, pool all the money, and then I bought shares for you. Then I can pool lots of people and make a smart choices what to buy. And that's exactly what a mutual fund is. Mutual fund is some fund manager. They collect money from thousands of people and they keep track who contributed how much, and then they can buy shares. So that's an easy and convenient way to invest, because these fund managers, that's what they do all day long. They wake up, they think about what to buy, what to sell. So you don't have to. So that's the mutual fund. Now, if you can replace mutual fund with a computer who automatically, based on an algorithm, buys and sells stock, that becomes a ETF or an index fund. So we'll look at this in more details in a second here. So the big difference between ETF, exchange traded fund, is you take all the stocks. Suppose you had bought 100 companies, Cisco and Apple and Twitter and Facebook. You had a whole bunch of companies which you had bought. You can package them up and sell them as single share. The single share includes the fractional ownership of a whole bunch of companies. The difference between ETF and mutual fund is ETF trades like a stock, but it is a bundle of whole bunch of companies. And I'll give you some example of what ETFs looks like. So you can trade it at 11 o'clock. You can buy it at 11 o'clock, sell it by 2 p.m. You cannot do that with the mutual fund. Mutual fund settles once a day. At the end of the day, they decide all the companies they own, what's the price. So ETF trades like a stock, and it is more efficient, doesn't have the fees. So many people love to use ETF as a way to buy whole bunch of shares easily. The most famous ETF is probably called Spider. Spider, or trades under the symbol SPY, like a spy. It is the 500 largest companies on the stock market. So by buying one share of SPY, you're buying a fractional ownership of Cisco and Apple and Johnson and Johnson and 500 companies. So isn't that better? That instead of trying to decide which company to buy, with one share, you're buying ownership in all of them. It's represent about 85% of all stock market valuation by buying this SPY. So you notice here SPY or Spider is an exchange traded fund. It trades like 326 on a couple of weeks ago. It's gone up. It went down when there was a big post-COVID crash, but it has recovered. It's gone to new highs. So this is a convenient and smart way to buy just one share and buying a whole market just with a simple. Let me pause here for a second. Any comments, question, reaction, or disagreements?
What if there are bad companies in those 500 SPY ETFs?
What other companies are in there?
What if there are like companies that you don't like in that ETF?
Yeah,
So
if you don't like, but the thing is that, so short answer is there's nothing you can do about it. It's the 500 companies as defined by Standard and Poor 500 index. So if you don't like it, then don't buy SPY and buy those companies individually, which you do like. So you have that flexibility. But my point is that when you say I like this company or I don't like this company, our criteria is usually emotional. And
I didn't really I didn't really mean I like or don't like. I really meant like, what if a company in those 500 has decreasing revenue or they're not doing as well?
yeah,
So
there's nothing you can do about it. This is a packet. This 500 things come in the packet. This, if you have that concern, then you should not buy SPY. You can buy individually the 492 companies you do like.
So is it similar to S&P 500?
Yeah,
It's just an
yeah,
yeah.
it is the S&P 500 packaged as a single stock.
I see.
So S&P 500 is Standard and Poor, which is the name of a company. They publish a list of 500 largest company by valuation, and that's called S&P 500 index. So SPY is all those fractional shares of this company packaged as a single stock. So it is S&P 500. That's the short answer. Same thing. So we'll
Yeah, actually, this is Naveed. Actually, if I can add a comment, right?
Yeah.
So if you want to track the performance of S&P 500, right? This is a very easy way of buying SPY ETF, and you would track that performance.
Yeah. So, and I'll show you what companies are in it and what's the formula in a second.
I have a question here, sir.
Yeah.
When they say S&P 500, S&P down by 24, S&P down by 100, what does it actually mean?
So it means that those 500 companies which are in that index, if you look at the collective stock price as weighted average, as a weighting based on market valuation, collectively they have gone up so many points. So if you take single stock, you can say the stock went up $3, $5. So if you taking 500 together in the weighted average, so collectively the stock price of all those 500 shares went up by 28 points.
I see. Okay. Thank you.
So that's an easy way to keep track what happened to the whole market. It's an easy way to track. So there are other indices like Dow Jones Industrial Average. You hear about NASDAQ 100. So I'll talk about that in a second. But first, before I go there, I want to talk about asset classes.
Naeem Saab, another question, if you can take another one. आपने कहा था exchange traded funds versus mutual funds. Mutual funds have fees, but exchange traded funds do not have fees. Is that they don't
Yeah,
charge?
थोड़ी पीछे background noise है तो दोबारा repeat करें.
Exchange traded funds, I think you said do not charge fees versus mutual funds that do charge.
Yeah. So let's talk about a little bit more detail. So mutual fund में ना, there's a manager, fund manager, and he has a bunch of staff members who do all the analysis, what to buy, what to sell. They have a nice office and all that stuff. So that has to be paid by somebody. So there is usually an annual management fee, which can range from 0.1% to 2.5% of whatever is in it. So you put $100,000 in a mutual fund, depending on the fund, and I'll describe that in about half an hour from now. You'll be paying anywhere from $100 to $2,500 every year for them to manage your money. Now, hopefully, they'll make 20%, so you don't mind paying 2% management fee. But ETF, there is no such fee. There's a very, very small, maybe a fee like a hundredth of a point, 5 basis point, but basically it doesn't have those fees. It trades like a stock. It's all managed by a computer. There's a very small fee, but it's almost negligible because there's no human being managing it. It's all done as a packet, as a computerized individual.
Can you elaborate just a little bit on the index funds also?
Yeah, so because I first have to tell what the index is. That's coming up in 7 slides later. So index fund, there are different indexes, and if index fund is all the, like Dow Jones Industrial Average is the index, and all the stocks which are represented by that bought together, that's an index fund. So they're all kind of index funds. But that topic is coming up in 7 slides later, and let me talk about asset classes. So asset classes. So these are different asset classes. Like I said, bond. Bond is nothing other than a loan. So Intel wants to build a new fab in Arizona. It costs $6 billion. Well, you can take $6 billion from your treasury, or maybe it's easier to issue bonds, a loan. Like people like you and I contribute $500, $1,000 so they can collect that money, build the thing, and then pay us over the next 10 years. That's what cities do, that's what state does, that's what the US government does. They issue bonds. So bond is a loan in which, depending on, then there are companies who rate the bond. देने वाला बंदा ईमानदार है कि नहीं है? So you come up, is somebody asking a question? Is a background noise? So somebody asked the question, how trustworthy is this? Will they really pay the bond? So US government used to be AAA rated, the most secure, trustworthy. Their corporate bonds, like IBM corporate bonds, extremely highly rated. City of Orange in Southern California, not so highly rated. They went bankrupt 20 years ago. So the whole fiasco happened. So the one I want to focus on here is the dividend stock. So this is a good one for you guys to know. Dividend stock is that you buy a company which is highly profitable. What do you do with your profits? Suppose company made $1 billion in profit. What do you do with $1 billion? Well, you can build a new factory. You can acquire a company. You can do some new products. Or if those are things that are not in your roadmap, the money really belongs to the shareholders. Why not give every shareholder, based on how many shares they have, part of that profit? This is called dividend. And which companies are generate dividend? Usually utility companies like Pacific Gas and Electric, PG&E, all utility companies, because there's no product for them to buy. They cannot like have a new, get into new businesses. They're regulated. So they give up most of their profit as dividend to the shareholders. Large companies like Apple also do the same thing. IBM does, Chevron, Exxon. So if you buy those shares, you have two possible outcomes. Not only the stock can go up over time if company does well, but company can also, you can receive a piece of their profit every year as dividend. Well, that's pretty good. Just for the sake of conversation, suppose you own, 20,000 shares of one of those companies, and suppose they pay $2 a share dividend. So every year you're getting a check for $20,000 on top of the potential of stock going up. That's a pretty good deal. So these are dividend stocks, and you should or can have, you can just buy a ETF, which is just a dividend stock. So this is an interesting thing to know. A lot of people don't appreciate that. So a portfolio is with the money you have, where do you want to put it? So in a reasonably conservative portfolio could be for a young person is portfolio 1. So you put 60% of them in a S&P 500 by buying SPY, which means you just bought ownership in 500 largest companies on the stock market. That's pretty safe bet. And you put maybe some in bonds, because bonds will steadily pay some interest level based on the risk, could be anywhere from 1% to 15%, because as yield goes high, the risk is high. Because if I'm city of San Jose and my finances are like a little bit not so strong, I may have to offer 8 or 9% interest to get people to lend me money. But if I'm US government, people know that I can collect tax, I'll pay you back. They only have to offer you 2% annual interest to take your money. So risk reward determines at what price the bond is issued. So this could be a simple portfolio of somebody who just has $10,000 to start with. On the right-hand side is more complex portfolio. So this is where you may have more money. You may divide between S&P 500, some small cap, large cap, bond, emerging markets, international. So that will be a typical portfolio. So this is what a portfolio means. The question is, where should I put money? Which asset class? Because all of these are asset classes. And if you look at how asset classes have performed in the last 5 years, that's the yellow one. And what's the expectation? How will they do in the next 5 years? That's the purple one. You can see what's being projected. So you notice in yellow one, US 10-year treasury, that's the leftmost line. This means a bond or a treasury bill, 10-year bond, that has paid like 5%. Cash, if you just keep money in cash money market, that's 1.3%. But you can see that S&P 500 in the last 5 years has done quite well, 10.7%. So this gives you an idea of what's expected and what's expected to happen in the future. And according to this thing, that emerging market are expected to do well in the future. So if you have a lot more money, if you have just $1,000 to $5,000 to $10,000, you go portfolio one, don't worry about it. But if you have bigger portfolio, then you need to figure out where should I put my money in. And this is an interesting chart. Every year, which asset class did well? But you realize it was never the same asset class. So this historically, if you look at 2006, equity did very well, for up 49%. 2 years in a row. But next year, 2008, they were minus 52%. Equity means stock market shares. That's equity. अच्छा, उसके बाद फिर gold did very well in 2008. But 2007, equity came back, did 83% in 1 year. And bond only did 4%. Bonds are kind of stable. But then 2010 and 11, gold did very well. Then equity did well. So point is, you don't know which way the money will flow and what will be up or down. So that's why you have either money managers who look at this thing and make decisions for you if you go that route. You can have people who manage your money. They take 1 or 2% of the portfolio as their fee. I've tried them all. I have dumped them all because I realized they don't add that much value. With a little bit of education, I can do just as fine. So that's what I did. I spent actually maybe $40,000, $50,000 in the last 15 years taking multiple courses, reading multiple things to educate myself, because I was tired of these stupid guys trying to tell me what to do, and my knowledge was same as theirs, if not better. But point is, it changes. It's not the same every single year. So based on risk reward changes. So money market, of course, risk is low, but reward is low. You can make 1 or 2% annual interest. Then high quality bond could be 3, 4, 5%. Low quality bond, higher risk, would be 7, 8, 9, 10%. Stock market portfolio risk is there, but reward can also be 9, 10 to 15, 20%. In international market, even higher risk and higher reward. So this gives you an idea that you have to decide what is your risk reward comfort zone and where should you put the money. So any questions so far which we can answer?
This is Nisar. How come the diversified international are more in your previous slide? Yeah, this one. It looks like domestic is not as, I know reward and risk, but looks like traditionally international diversified stock has paid more. Yeah,
because they're very volatile. So in a good market, like, there was Asian targets were high, Karachi Stock Exchange was giving returns were like the best in the world in the 2010-ish. And then Thailand was up 81%. So there you can get high return, but the reward is high because when they crash also big time.
I see that because in 401k, I have international diversified, and over time they have paid more.
Good. They have been good or not good?
They've been good, yes.
Yeah.
Better than domestic, yes.
Exactly. So, that's the thing. If in the right international market. Now, let's talk about what is the sector fund. So you can also find ETF, which are only in a specific sector. For example, you want to buy just the software companies or all the biotech companies. So there are such products that you can buy with one ticker symbol, 50 companies in like I said, software or biotech or anything. A popular one is something called symbol called GDX. GDX is like 50 or 60 or maybe more company in precious metal mining, gold mines. I don't know which gold mines to buy, so I buy GDX. It has a whole bunch of gold mines in it. It's a very sector specific thing. Again, high risk, high reward. Or you can just buy, you don't know which COVID company is going to do well. You buy one symbol, which has all the companies of companies into a single symbol. So that's a sector fund. Other thing you'll hear sometime is large cap, mid cap, small cap. Like, what the heck does that mean? So let's demystify that. So a market capitalization, shortened for market cap, means if every share of that company could be bought, how many how much money would it take to buy every single share of that company? So suppose Apple stock is $120 a share right now, approximately. So if and I guess I could do my math here, but it may have like 1 billion shares outstanding. So if every single share, all billion shares were bought at $120 a share, that's the market capitalization of Apple. It's actually $2 trillion. So market cap means if every share could be bought, then how much would it cost? So companies which are considered to have $10 billion to 200 billion, they're called large cap. So most companies like Chevron, General Motors, Ford will fall in that category of large cap. Small cap is 300 million to 2 billion. And of course, there's a micro cap and nano caps. Normally, these are much more volatile, much more risky companies, but they do exist. So I hope that is clear. So somebody asked, Asma asked the question, difference between low quality versus high quality bond. And answer is, it's the risk reward ratio. An example I was giving was if you are a very known stable company, let's say Cisco, they wanted to open a new factory. So they are a company which is known to have good earnings, stable company. They can issue a bond, and let's say at 4 or 5% annual interest rate. And people will be willing to say that's pretty stable company. I'm going to get my money back. I don't mind. But if some other smaller company, which is more risky, they want to raise $1 billion or $500 million for some purpose, people will say, who are you? Are you stable? Can you really pay us the dividend? So we are willing to give you, but we need higher return. So they may have to offer at 8, 9, 10, 11% interest rate to get the bond sold. So high quality bond means that it's a low risk, low reward, and you hear the word junk bond. Junk bond is very high risk and very high reward. In junk bond market, you may end up paying 15, 16, 20% interest to raise money, but you're giving that interest because people find you too risky. And companies like S&P 500 and Moody are two large companies which rate each company and each city and each state for their credit worthiness. So I think Pakistan was rated recently, was upgraded from triple B to something BBA or something. So they're like triple A, double A, one small A, all the way to B, C. This is the different credit rating of different countries, companies, municipalities, so on and so forth. So let's talk about indices. I mentioned this was coming up after a few slides. So the famous indices are Dow Jones Industrial Average. You hear about that in radio every day. What the heck is Dow Jones Industrial Average? You will be surprised to know how many shares, how many companies does Dow Jones Industrial Average represents? Well, you'll be surprised to know it's only 30 companies. Only 30 companies, which are chosen by one guy. So one guy, the editor of Wall Street Journal, chooses which 30 companies, and they change. It's not the same 30 all the time. They have changed over the years. So these companies divided by a certain factor, they represent the Dow Jones Industrial Average. And just for fun fact, when Dow Jones Industrial Average was 381 before its crash in 1929. It crashed. So, and then it goes up and down. The last bull market run started a day before my birthday on August 12th, 1982. It was down to 777 was Dow Jones Industrial Average. It has now gone from 777 to now 29,000 and change. So that shows you the collective, those 30 stocks have how they raise. The most popular one, more realistic one is S&P 500. So S&P 500 is a weighted average based on market capitalization of 500 largest companies in the stock market. So this represents about 80+% of all stocks valuation, much more reliable than Dow Jones Industrial Average. NASDAQ 100 is the largest non-financial companies, mostly technology companies, which trade on the NASDAQ stock exchange. And so any questions about what the heck is that these indices mean? So give you a little bit more factor, like in Dow Jones Industrial Average, which companies are included? So you notice the companies include from NASDAQ and New York Stock Exchange and wherever else. And this shows you what kind of company it is. So like 3M company was added in 1976, but Amgen was added this year. So, and this tells you on the right-hand side, index weighting. So the weighting changes. So one guy, this Dow Jones Industrial editor, they decide the weighting. So it's kind of an artificial way to tell what the market represents, because you can play with weighting, you can play which companies you want to include. Apple was only added in 2015. Apple was not part of Dow Jones Industrial Average. Okay, let's look at S&P 500. Similar concept. These are the 500 companies. And you can notice here, Google is here, Class A, Class C separately, Facebook, Apple, Microsoft. And there's a weighting factor because Apple is much bigger in size than Facebook. So Apple is given a weight of 6.5, Facebook given a weighting of 2.2. And some other companies like Home Depot is given a weighting on the bottom, number 14, 1.01. So this weighting is determined by market capitalization, and it changes, in a somewhat regular basis. So point is, by buying one share of SPY for $326, you're buying a part of Warren Buffett's Berkshire Hathaway, number 7 on the list. You're buying part of Google, part of Apple, part of Facebook, part of Amazon. Now, if you were to go buy individual shares of all those companies, you need to have a lot of money. But buying SPY, you just bought all those companies. Beautiful.
So a company can be in both of those. So Dow Jones Industrial is in Apple, and then S&P 500 also.
Exactly, because different people are just picking those indices based on their own criteria. Yeah, if you own both Dow Jones Industrial Average, S&P, you have Apple two ways. Yeah. So this shows you over the last.
So can I interrupt just 1 second? I just want to clarify for my own sake.
Yeah.
So I think Tesla just joined. Was it the S&P 500 recently?
Yes,
I think that's right. Yeah.
So does it mean now Tesla is gone from, company's reputation from a certain image to, like a AAA company now because it's added to this S&P 500?
So short answer is no, but the long answer is it's purely mathematical how it's added because market capitalization is so large that it has to be included. But it does have a little bit of prestige because many companies by decree have to buy so much S&P 500 shares. So if Tesla gets included, there'll be a pull for more shares of that to be bought. So in some obtuse way, it's a good thing. It doesn't make you a AAA company. It doesn't mean that you're a AAA rated company or anything like that. It just means the demand for your shares go up, which is different than are you a more credible company than you were yesterday. Doesn't make you any credit worthy. It's not better, but there's a bigger demand for your shares because by decree, companies have to invest in S&P 500, and when you get part of that bucket, you get pulled.
So looking at risk reward ratio, if you invest in companies like that which got upgraded and got included into this elite of companies, and if you want to invest in the long run, are you betting that this company is safe now?
So short answer is no.
Okay.
What you could expect is a temporary short-term pull in the positive direction. Suddenly when you get included in S&P 500, suppose there were 1,000 different funds, like Indonesia government fund, they have to buy 10% of their asset into S&P 500. So if Tesla gets included in S&P 500, they have to buy now so much percent of Tesla. So short term, there's a bump, but it doesn't mean it's a long-term safer bet, anything like that.
So it's good marketing for the company itself.
It's good marketing for the company, and if you're smart and you're timing the market, you can buy the moment they announce they're going to be included and sell 2 weeks after they do get included. So you may have a small bump, but it's not a long-term viability or anything positive.
Yeah, and if
And
I can add a comment, right? So when Tesla gets added, it's at the cost of some other company, right? Because it's 500 companies, so Tesla is going to get added,
Somebody
and it's going
get
to replace
distracted.
some other company, right?
Yeah.
So
Yeah,
just being in S&P 500 is no guarantee of longer-term company's viability or strength, right?
exactly.
And as long as it comes out, you put it in, it also has a chance to go down also drastically. So you lose over it a big time.
So I have a question. So if, let's say, is it good to buy Tesla as an individual stock at this point, or as an S&P? As you said, there'll be a bump like for 2 weeks or so.
So that is, of course, a personal question based on your risk-reward ratio and how you feel about the company. I can answer both ways. Personally, I'm not buying Tesla now because Tesla just had a stock split. So stock really is about like $3,000 if you look at without the split. This is more valuable. Tesla makes Tesla more valuable than GM, Ford, and Volkswagen combined, which is a little hard to swallow. On the other hand, if you look at long-term trend, Tesla is not just a car company. Car is small portion of their overall value proposition. Imagine if you bought every single gas station in the world. Imagine you bought Arco, Chevron, Exxon, all the station. Wouldn't that be a profitable way to be? What Tesla is doing is by superchargers, worldwide network. When all cars go electric in 2030 in Germany, and I think whatever is California, 2040, 2035, something like that. Then if you own all the gas station in the world, that is a very sweet model. And they will also be selling drivetrain and the maps and the software to many, many companies. So if you look at Tesla from both lens, Tesla is undervalued. So you need to decide which lens you want to look at Tesla. Personal disclaimer, I'm not directly buying Tesla because I think it's quite overvalued, but I'm going to wait for a chance to get in.
Very good answer. Thank you, Naeem.
Naeem, sir, I have a question. On your weighted chart that you had, Apple had a lot higher and bigger weight than Google, and is the reason like Google is 1.2 trillion market cap and Apple is 1.99. Is that the only reason? And then second question is, what's the Alphabet A and B and 1 and 2, what are the differences between two different stocks of Google and the similar I saw in some others also?
So the first question was that first question was that why is Apple a bigger fraction weight?
Is it all, we can see the market cap is bigger. So is that the only reason?
That's the only reason. It has no other qualitative metric. कि भाई वो तो लोग बहुत ही अच्छे हैं, खूबसूरत भी हैं, उनका ज़्यादा कर देते हैं. No, it's all mathematical, all multiplier. Second thing, the difference in Class A and Class C, and answer is I don't know the answer.
I think the answer may be, I don't know, I may be wrong. Berkshire Hathaway, it's
that one I know. Yeah.
Class A, the real value of that one stock is about 250,000 or 300, whatever it is. The Class B is like a muted down version of it.
It's a fraction of that.
Yeah, it's a fraction of that.
And Amber, when you zoom in, what do you want me to zoom in? So Amber, you can text me what zoom
Never
in.
mind, I got it figured out.
Okay. Yeah, please go ahead. Sorry, Nabil.
Yeah, the Class A, Class C, the rating, like the different stocks, I think it has to do with the voting structure. Yeah. So different companies do different kinds of things with their voting structures, and sometimes it can get controversial. So, for example, if you buy, I think it's Class C Alphabet shares, you don't get a vote in their, whatever.
That's understandable. The question is why in S&P 500 they'll be listed separately. That's the curious part. That why own Class A and Class C, because voting is not the issue here. So there may be some other nuance here for Alphabet. In general, you're absolutely right. So anyways, that gives you some idea of different indices. And if you look at these indices, how they have done, this gives you a little bit more thing. So you notice that the pink line, that's the NASDAQ 100 shares. So you want to buy, by the way, this 100 shares, mostly all technology companies together as a single share. The symbol is QQQ. The ETF is QQQ. Just like you can buy S&P 500 with the one symbol called SPY, spider, QQQ, you can buy 100 largest technology companies with one single symbol. So you notice here how it has performed. You know, there was a dip for all three symbols in March after COVID started, but they all have recovered, and QQQ or NASDAQ 100 has recovered the best. It's up 38% for the year. And the S&P 500 is up 11%, and Dow Jones Industrial 3.3% since January. So, of course, some of us, you know, got freaked out after the COVID crash, took the money out, sat out most of the year, missed out on this beautiful gains. So that's why my advice is trying to time the market is not smart. Market is too smart. Mr. Market is a term Warren Buffett uses. Mr. Market knows everything. Everything is figured in. Don't try to time it because you will be wrong. You need to have a different philosophy how to invest, which I will give you a little bit more insight on in a few minutes. So before we switch gears to how to read charts and how to invest, we basically concluding our chapter 1, which is the big picture, describing the terms ETF, mutual fund, indices. So we're closing that chapter and now going to a second chapter. So any question before I close the chapter? All right.
Perhaps,
yeah, others?
Perhaps you will probably take that in a next chapter about when you are making individually your decisions to buy certain stocks. I think certain company parameters that you need to look at, for example, PE ratio and other ratio, maybe perhaps when you
yeah, that's next chapter. Yeah, that's coming up. Yeah, the three chapters in the stock. First chapter was the basics of stock market. Second is how to invest, what's the method of investing. And third chapter is option. Is there a way to make money in option? And I'm going to share with you absolutely 100% you cannot possibly lose your money method in option trading, which is going to freak some of you out. So that's the third chapter. Okay, so let's look at the next thing, which is, so by the way, how to read a stock chart. This is also, you see, we'll log in and see it. You can notice in the top, you can look at how the stock performed. This is year to date. I'm looking YTD is year to date, but you can also could have looked at 6 months, 1 year, 2 year, 5 year, or max ever since inception. How has it done? So very easy to look at performance on. All these tools are available for free. So we'll touch on that in a few minutes. Okay, so let's see, when you say stock chart, what does that mean and how do you read it? So this is Apple stock chart. I took this shot maybe October 30th, I guess. So you notice here, I'm looking at a 5 year. I clicked on the 5 year. How has it done in the last 5 years? So this gives you an idea. It used to be close to like some dollar. Now this is adjusted for any stock splits. We'll talk about stock splits in a few slides. So because Apple recently did I think 5-to-1 stock split. So if you had Apple share was stated $500 some dollar, they did 5-to-1. You get 5 shares at $100 for every old share you used to own. So you notice the stock 5 years ago was like $20. It has slowly gone up, some ups and downs in between, but gone up to 120. So how do you read it? This is how you read it. So it tells you as a percent, how much has it gone up in 78%, 78 points, which is 259%. And what is it trading after hours? This is the price. And then you can click on any of these things to see how has it done in all-time high since its inception, in 1 year, year to date, 6 months, so on and so forth. So then you look at, again, more details are available, again, for free at Finance.
Naeem, I'm sorry, I have a question on the previous chart that you have. Yeah. It's accommodated for the splits, right? Yeah. So in 2017, let's say it was $500, and 2020, it was split in half. So the numbers on so then it will, the left side, which is 20, 40, 60, 18, 120, will represent today's the number, the value, and then the previous curve will accommodate and adjust to it.
Exactly. So all previous numbers will be revised as if today's stock price. So in fact, if we were in 2017, you looked at it, stock may have been $80, but now because stock was a split, it goes back and corrects all those values accordingly. So you're absolutely right.
Thank you.
So
question, names Asif here. I think I already kind of know the answer, but then maybe like when the split happened in the next week or so, just recent split, it divided into multiple stocks. Then a new iPhone came up with a cool camera and gadgets, and which it didn't properly reflect on stock. Like the real business should have said that there will be a lot more sale, but then stock market didn't respond accordingly. What is maybe you can address 1 or 2 minutes?
yes, so the reason is I go back to the Warren Buffett's terminology. Mr. Market knows it all. In other words, market was already anticipating iPhone 12 will come. It already anticipated it will have these cool features. It anticipated it will have some strong sale. It was all reflected in the stock price. So there was no surprise. It was like, yeah, that's what we expected. We already have priced the stock accordingly. Stock market is all about what do they anticipate. When you surprise the stock market, then there you see some dramatic movement. But that was all anticipated. There was no surprise.
And if the anticipation is not met, then stock will come down, even if the new iPhone 12 comes.
Yeah, it's a little bit more complicated, but short answer is yes. Because sometimes when you surprise the market with much better than earnings, stock can go down instead of going up. You will say, what the hell? How can that be possible? We were expecting company to earn $2 a share, company earned $3 a share. I expected stock to shoot up. No, stock probably will go down. Reason? Because unpredictability is punished. Management was not able to give proper guidance. This means they don't know how to run the company well. They're unpredictable. Market hates unpredictability. So even if you surprise them above the thing, that's unpredictable. That's not as good. Of course, if you surprise them in the low, that's worse. So if you notice, this is a separate talk, but let me just give 1 minute version. So good companies who have the flexibility, have these levers, they do financial engineering to always deliver earning just a penny above what people expected. Just a penny, not 5 pennies, not 20 pennies, just a penny above. How do you do, what levers do you have? We have many levers. You can decide what is prepaid revenue, what could be hidden in the balance sheet. You can buy back your own shares to change the denominator because earnings per share. You had 1 million shares outstanding, earnings became high, your earnings went low, you bought back some shares, you reduced the denominator. All this financial engineering is done to meet the expectation. In companies who cannot do that despite these levers is punished. So let's look at some of these, let's look at Apple. So notice when you go to yahoo.finance.com and put in Apple, which we can do right now in real time, you see all this interesting data on the right-hand side. Some of you will be intimidated, like, what the hell? Don't be intimidated, it's not complicated. Let's take a look, what do we have here? So it tells you stock closed, previous close yesterday at $119.21, market cap, which is if every stock could be bought at this price, how much dollar would it take? 2 trillion. Beta is an index of volatility. High beta means more volatility, less than 1 is less volatile. 1 is like the default. So some boring company like PG&E will be less than 1 because, you know, it's the same electricity, same home, same thing, very non, so it'll be less than 1. And this is a little bit higher than 1. Price to earning ratio. So what's the price of the stock, which is 119? How much is it expected to earn? Well, earnings per share is expected to be $3.28. So you divide $3.28 by 119, that gives you price to earning ratio. When is the earnings will be announced? January 26, 2021 to February 1. This is the date when they'll be computing and announcing. Is there a yield? Does it give dividend? Yeah, it gives a 82 cents dividend per share. That's 0.69%. When is the date dividend will be given? All the shareholders who were registered as of November 6, 2020 will get this dividend. So a lot of people buy the share just before this date and sell after this date just to collect the dividend. So there's some rules about how long you have to hold it. So then in 52-week range, last 52 weeks, it went as low as $53 and as high as 137. In 1 day, this was the range. Bid and ask. And remember, it's an auction. Somebody's trying to bid the shares. Somebody's trying to buy the shares $119.12. And somebody's asking to sell the shares at $0.15. So that's a delta between the two, bid and ask. Somebody's willing to sell, somebody willing to buy. There's a 3/100th of a penny difference between the two. So this is a very heavily traded stock. So these things, average volume means how many shares are changing hand on average. And so average volume is 158 million, but yesterday only 78 million shares were traded. And the bottom left-hand side is interesting. Is it overvalued or undervalued? So stock which is overvalued is likely to come down. Undervalued will likely to go up. So you notice a lot of stuff is packed here. The things people look for are these things: price to earning ratio and EPS. So here's a secret ninja trick for you. If you look at the average of all stocks on the stock market, the average price to earning ratio for all the shares is around 17. If the stock is EPS less than 17, chances are it wants to come up to 17, stock will go higher. If stock is over 17, it's likely to want to come down to 17. 17 is like the mean. So when bull market started in 2000, I mentioned to you, it was because that date is close to me. Sorry, hold on. So on August 12th, 1982, it was the start. So that time, the Dow Jones Industrial Average was 777. So this thing about price earning ratio, I said average is less 17, the most stock here. So in 1982, in this date, it was down to.
Yeah, I'm listening.
And in the 2000 crash, when it happened 2001, it went as high as 42. So you can see when it was down to 42, bad things were about to come, and they did come. In the beginning of the bull market, we're down to 6. So this is when you look at its stock overvalued, undervalued, how far away it is from that 17 magic number. So let's take a look at two stocks side by side.
Naeem, before you go further, I think Bilal had a question. He just wanted to have the data explained again, which I think is a volatility index. And then I have two questions of mine. If you can answer all three of those. These charts that you have, where did you get them? Previous one of those I saw was Yahoo Finance, where these charts are from. And then a question on the dividend date. How, if you just enter a day before the dividend date in a stock, you get the dividend? How long the maturity is?
Somebody other than myself can answer that question. Usually, do you have to hold the stock for so many weeks or months before you're eligible? But I could be wrong. I don't play that game, so I don't know. But somebody else may know this answer. Okay, how long you have to hold each stock to get the dividend?
Yeah, as long as there is what's called the dividend book date, as long as you hold the stock on that day, you get the dividend. Because right after that, you'll see, based on the dividend, the market basically drops the price of the stock based on what dividend the company is going to pay.
So only you have to hold that day. So you can literally buy the day before, sell the day after?
No. But how sooner is that date? Yeah, typically.
Right here.
The ex-dividend date that you have to buy it by.
Just look at here, ex-dividend date, November 6th, 2020.
So you have to buy the stock before that date.
Yeah. So buy on the 5th of November. You can sell it on 7th of November.
Well, somebody was saying the opposite. Somebody was saying there is a mark date where they evaluate, which is something before that. If that is the true, I understood it right. Any idea? Is it typically a week before, a month before? If somebody was saying that.
No, as long as you own the stock 1 day before the ex-dividend date, dividend is yours.
Oh, okay.
You can sell it after that.
Right, but again, right, one thing to clarify is, right, typically that's most of the time that's dialed into the market, right?
Here's the answer right here. You only need to own the stock for 2 business days to get a dividend payout. Technically, you can even buy the stock a second left before the market closes, still entitled to the dividend.
Wow.
The 2 days are because the stock transfer certificates go over to your name. That's why.
Yeah.
So, but actually, the stock price will go up because if all the crazy people are buying day before, and if they're trying to sell it day after, then it's going to crash down.
That's getting too smart. I advise don't get too smart. Just play some sensible game unless you have all the time in the world. So somebody says, how do I find these things? Well, if you go to finance.yahoo.com, it looks like this. You put whatever your favorite stock is. My current favorite stock is AMP. It's a COVID vaccine. Probably shouldn't show you this because you will not like it because it's a penny stock. But this is a stock which is making a tablet for COVID. So not this vaccine which has to be frozen and all that stuff, but it's a tablet. It's in phase 3 trial. I'm accumulating this stock. It's less than $1. So most of you will turn your noses up on this stock, but don't. Check it out. So this is what it looks like. You can look at, but let's look at some stock which you will recognize. So something more easy. Let's look at Apple. So go to Apple and let's see. So here's all the data is here. So you can see what Apple did in the last trading day from 9 a.m., 9:30 a.m. when market closes to 4:30 p.m. market close. That did. So look, show me last 5 days. Then you can, in 5 days it came down. Show me last 1 month. Look at 5-year maximum. This is since 19, whatever, when is this? 1991 it went public. So it shows you how it behaved 5 years. Look at, that was maximum. 5 years, 1 year. So it shows you the volume, how many shares were trading every day down here. And green means it overall went up. In this case, you can see it went up from $360, went up to $518 in 1 year. Then it had the adjustment. So this is a 1 month chart. So this is still, oh, I'm not looking at Apple. I'm looking at some other company. That's why it's still at $500. What happened to my Apple? Apple, okay. So here you can look at Apple and you can look at 1 day max. Let's look at max just for fun. So Apple went public in 1980, December 1, 1980. So how it has done an all-time high. You can look at 5 year, you look at year to date, 1 month. So all the information I was talking about right here, you don't have, it's all hidden in plain sight, free. And if you, some people like the simplicity of Google, so you can go to finance.google.com. Oh, sorry, I didn't type very well. Finance. They have a little bit simplicity in the charts, easier to read sometime. And again, we can look for NASDAQ, Russell, whatever. Let's look at Apple, just looking at the same thing again. And charts are a little bit simpler, easier to understand. 1 month, 6 months, year to date, all-time high. So, and all the information, you look at financials, you can look at the financials. I personally like the finance, Yahoo Finance better because I can see a lot of data in one place. But I'm saying is all this stuff is right here. So you can compare, for example, I'm comparing Apple with NVIDIA. NVIDIA is yellow, Apple is color. I can also put Tesla on the same chart. So I can play with it, look at how this compare with each other on each date. You can add Microsoft to the same thing, maybe even Amazon. So the point is, we wanted to do this thing, you can compare side by side and able to take things together. Okay, let's go back to our presentation. Yeah. Okay. So let's compare this thing with another company, let's Anheuser-Busch. Anheuser-Busch makes liquids, And company, again, you can look here, the beta is only 1.13, which means it is less volatile. Yeah, by the way, S and Vixert, I also own Vixert, loving Vixert, you're right, VXRT. The earnings per share is negative because they're losing money per share. And since they're losing money, the price earning ratio doesn't make any sense, so not applicable. But if you look at the valuation, they're not overvalued. They're kind of a middle of the ground. So the stock closed at $65, all the usual things. IBM is right here. IBM is still overvalued, but price earning ratio is much better than Apple. It's only 13. And market cap is 104 billion, not 2 trillion. So maybe more possible upside here. They're giving a 5% dividend. That's pretty sweet. 5.5%. So you cannot get 5.5% in your bank or money market. You buy IBM, not only you're getting 5.5% annual income, plus chances are IBM should do well as a stock. So this is like double whammy. So dividend generating stocks could often be a good thing to look at because 5.5% dividend annual is pretty sweet. So any questions about this thing, or could we keep going?
Just on analyzing stocks, I've heard of other metrics like growth,
Nabil, you got cut out, so if you can ask again.
Oh, can you hear me better now?
Slightly.
Okay. So I was asking, I've heard of other metrics to analyze stocks like revenue to growth or sales revenue and so on. So how do you view those?
So my point is that, there's no reliable metric. Mr. Market knows all. You can grow your revenue, but suppose you start wrapping $2 bills around everything you sell. So your revenue will go like this. Does that mean that this is a good thing? So what really want to look at is profit, earnings. Earning is profit. Is earnings growing or not? If your dividend is increasing or not. So that's better metric. So this is, if it was this simple, everybody will be rich. Question is, it's not that simple. The market knows everything. You think you have some secret inside information nobody knows? Unlikely. And if you really have insider information and you're buying stock based on that insider information, then you'll be in jail, like Martha Stewart went to jail, because then you're using insider trading. You're not supposed to do that. So just because your son works at this company and he whispers at the Thanksgiving dinner, yaar halat bahut kharab hai, to stock to marne wala hai, and you buy shares next day based on that information, you'll be in jail, or could be in jail, I should say. So that's the point. So point is, you cannot look at just one metric. That's why I have learned not to get too smart, because no matter how smart I think I am, I'm not that smart. So that's why I buy index funds or this ETF, because it's all figured into that.
Naeem साहब, आप another question, आप जो charts दिखा रहे थे previously for Anheuser-Busch and IBM, at the very bottom it shows estimated return.
Yeah.
Is that based on dividend and potential price change? Is that how they calculate that, or
I think so? But this says view details, so we can probably go there and look at that in real time. So let's look at finance, because Yahoo Finance does that. So let's actually look into this, and let's look at in real time into IBM. Hello, IBM. Why can't I type? IBM. Why can't I get to IBM?
Because you can't type IBM on a Mac.
Really? I think so. Okay, so, and it says here, let's look at view details. So let's see, does it tell us anything? So subscribe to premium to find fair market value price. I think it does include both dividend and potential appreciation, but you have to pay money to find out. So this is some analysis which is sold by Google. And I think it assumes both. So, I don't want to start my free trial right now, but some of you may want to do that. Yeah, so this is their way of selling some additional information. So my understanding is it includes potential gain, including dividend, for the next some period of time.
Okay, all right, thank you.
Okay, let's go back to
topic of ETFs. I had a quick question. I was wondering if you can show some light on why QQQ has done so well compared to Dow Jones and S&P 500 SPY, and any, how long is it going to do that? I mean, nobody knows, but any thoughts
nobody
on
knows. The short answer is it has done well because of COVID.
Even if you go back like 10 years, 20, up to the .com days, since the
because even .com days, because technology is changing the world. So all the technology companies are being adopted, and we are just getting started. I mean, technology has not penetrated in agriculture or construction to the level it has penetrated e-commerce or retail. So as more and more of this gets incorporated, technology companies will do better than non-technology company. So this is QQQ over since March 1999. Last 20 years or 21 years. So it's done extremely well. 5 years, it has done well. 1 year, it has done well. Year to date, it has done well. 6 months, it has done well. Yeah, so you can see why the 1 day and 5 days is not done so well, because it's understandable. When COVID hit, which companies became useful? Zoom, Slack, all the technology companies, internet, routers. So it's understandable that technology and QQQ should continue to do well into the near future, just because there is a greater need for those.
Okay, thank you.
Naeem Saab, I had a question on PEs. I know that's something that people consider, especially when you're starting to buy stocks, as to what a PE of a company is.
Yeah.
But not generally, I guess if you look at these aggressive companies, the companies that are doing really well, that go up 1,000% over a few period of time, like Amazon, its PE is at 90, and Nvidia might be in the similar range. So that's something to balance out as to what PE makes sense for what stocks, and whether you need to look at PE in different segmented markets. For example, in the technical segment, whether the PE should average at a 45 and you're still comfortable with it or not. How do you differentiate between 17 PE, which is for the average for the market, but really, if you look at the stocks that are going to do really well, their PE is usually in the 4 or 5 times as much.
So I think PE, which is price to earning ratio, okay, is a function of how much will you earnings divided by the price of the shares. In each industry, it is quite different. So I'm going to look at PG&E, because PG&E is Pacific Gas and Electric. It's not a company which is expected to grow super fast or anything like that. And the share is $12 a share. And PE ratio is not meaningful because it's supposed to lose money. Well, maybe they have too many lawsuits against them. What will be a boring company? Let's look at Chevron. That should be pretty boring. So Chevron also has a negative price earning ratio. I don't know which company will have a low PE ratio. I have to look around for it. So
look at Intel as a low PE.
All right, let's look at Intel, INTC. Yeah, so PE ratio is $8.88. It's supposed to earn, it's $45 a share, supposed to earn $5 per share as earning. So that's, you can notice here, it's very undervalued. So potential return 22%. So this will be kind of company which you may be tempted to think that is going to do well. But for the whole year, stock has not done well the whole year. In 5 years, I'm sure it's done positive, but in the last 1 year, it's been gone down from high of $68 to down to $45. So folks, before I start losing people, because you have been patient for 1 hour and 15 minutes, I still have my chapter 3 about option trading. So if you don't mind, let me finish and go down to the 3rd chapter. So nobody feels they didn't get what they wanted. Acha. So let's talk about the 3 ways to buy stock. So you could do fundamental analysis. There's a quantitative analysis and technical analysis. What's the difference between the 3? So fundamental analysis, you're looking at those fundamentals like price earning ratio. What's the company priced at, what not? Then you can do quantitative analysis in which you can look for some unusual value, because company just like when Tylenol had a big scandal, that Tylenol was polluted. Some of you remember this happened like 20, 30 years ago. The whole market crashed. Or Chipotle had their big disaster. Chipotle stock crashed. So these are value investing. So people just go in and buy because fundamentally nothing wrong with Chipotle. They had a bad PR event. So let's pick up shares when that happens. This is called value investing. So you look for some unusual reason why some stock is undervalued because of bad public relation or something funny happening. But long term, there's nothing wrong with the company. The growth investing is, again, looking for stock which are currently undervalued, and they look for indicators like price earning ratios and all that stuff. The third way is technical trading. And I sort of believe in technical trading because all this research I used to do, at the end, it wasn't correlating with my performance. So what technical trading means is Mr. Market knows it all. The reason people buy shares because they feel good about it or they've done all the analysis. So technical investing is basically very simple. What it says is, let me draw it here. What it says, technical investing says is that you basically are, if stock is moving like this, it's already moved up, you're going to catch a moving train when some indices tell you to get on the train, and you automatically have a way to be kicked off the train when stocks begins to drop. You have trigger point which will automatically kick you off. You will gain, you have, this is your gain. You're not going to get the lowest price. This may be the lowest price. You're not going to get it. Don't try. You're not going to get the highest price. Don't even try. You're going to catch a moving train, and you have, when you begin to drop a certain percent, you automatically will sell it. This is technical trading. And turns out, for me at least, or other people I've observed, that is more reliable than all the analysis I used to do. Because all those emotions are built into it. So I can give you the 5 rules how to do technical trading, which is you never buy stock unless it has daily volume of 50,000 shares being traded, because worst thing is you're trying to sell it and know there's no buyer. You buy a company with a market cap of greater than 1 billion, and you look at something called moving averages, which give you when to sell and when to buy. And I use 5-day moving average, 70-day, and 161-day moving average. Why these numbers? I have to talk about Fibonacci number, which I won't bore you with Fibonacci, just know the name. There's a science behind this. And 323 is another one. So when these things cross, you buy. When these things don't cross, you sell. And I'll show you some of these things. If you want to learn more about where to invest, go to investor.gov. That's a government website, lots of simple education to train you, teach you about investing and fundamentals. So that's a good place for you to think about, investor.gov. So here we're looking at, again, asset classes, which asset, now that you understand the asset classes, which were done well when. So you, on the bottom chart shows you annual best worst year for large cap stock, S&P 500 index, annual 8.1%, best year was 32%, worst was minus 37%, average is 8%. So you notice here, you're still better off being in the stock market than being in your checking account. Because checking account, you're getting a 0.1%. So don't get freaked out if stock market goes up and down. If you have a long enough horizon, and unless you're 65-year-old, then maybe horizon maybe shrinks. But if you're younger than that, you have plenty of horizon. Look here. In 2006, real estate investment trust, they were up 35%. Next year, they were all the way to the bottom, minus 15%. Emerging markets were hot. Then high growth bond funds were hot. Then emerging market. So you notice every year things move around, shift around. So that's why if you have a portfolio which have a bunch of things, or you can move every year in some, based on some research, you can do well. But even if you just leave it in the diversified large cap, on average, you should do 8% annual with all the best and worst year included. So this chart down here should be a good summary for you guys. If you just look at S&P 500 alone, this shows you some of the details, what happened inside. So different, look down on the bottom. Inside S&P 500, there are different indexes: financials, energy, consumer staples, industrials, material, real estate. You can buy those things separately, and you can see the changes. So since we don't know, you just buy the S&P 500 and you don't think about it. You get them all. They all kind of work out. You can drive yourself crazy unless you really, really want to spend some time into it. I used to. Now I don't. That's like, whatever. The point is, you can want to get into that. It shows you what was hot, what was not, in different sector go up and down. It's never the same sector. So just buy S&P 500. Allah Allah khair sallam. Acha. So large cap, large blended share. Blend means there's some dividend generating stock, some bonds, large companies. This is the return, which is a stable, simple, good return. So this hypothetical growth of $10,000 invested in 2011 with all the ups and downs should become more than $25,000 by now. So if you just left it, did no research, completely forgot about it, that's what have happened to you. This happened to my daughter. I gave her for, I don't know, whatever, graduation money, $5,000. As clueless as she is, she forgot about it. She had it in Charles Schwab. She totally, for last like whatever, 6-7 years, it was sitting there. She just discovered she has $11,000 in the account. So 5,000 became 11,000 because of her own naivete. She did not know she even had it. She forgot about it, as she's clueless. So I hope she's not listening. Okay. So now the question is, how do I select what to invest in? And all that is available for you for free. You can log into one of these Schwabs or Fidelity, and they will have all this information. So I'm just looked at Schwab, Q4 2020 Select Fund. These are different funds. These are electronically traded funds or third-party funds. Tells you how have they performed. So let's look at 3-year or 1 year. Benchmark S&P 500 did 9.7% in 1 year, 10.4% annual return over the 3-year average. 10-year average is 13%. Then you can look at different funds and how they did, compare them to the benchmark. So you notice there are many funds which have done well. Some even better than the S&P 500, like 12%. This one was 56%. Look at that. American Century Investment, large growth. So this done extremely well. Some of it. So all this information is available for free, and you just click on the trade and you can buy 1 share, 10 share, 100 shares. It's that simple. So this is again looking at Apple. This shows you the historical chart. This D shows when the dividend date was, so when the dividends were paid. And I think E is stock splits. Where does it define me? What do these things mean? So low was 53, the high is 137. All that information is in front of us. Charts, details, all available.
In the previous slide,
yeah,
the last one, as you mentioned, so it's a mutual fund, right? Is it?
I have to look at it. It's a mutual fund. Well, yeah, 5 digits really means mutual fund. Yeah.
Okay, so it means okay.
Yeah, yeah. We can look at it in real time in a minute, but I just wanted to give you a sense that this all information is available. It doesn't cost you anything if you have a Schwab account or a Fidelity account or a Vanguard account. And somebody talked about stock split. That really is a mathematical error just to get in people optical range. It's got nothing to do with company valuation. Because some people say, I want to buy Apple. Oh, $500, too expensive. So when they do a 5-to-1 split, instead of one fat $500 share, they give you 5 skinny $100 shares. You feel, oh, it's cheap. I can buy it now. Pure psychological manipulation in your own mind. So one stock $4 share splits into two $2 shares. It's just to get into optical range of reasonableness. One company which has never done split the stock is Berkshire Hathaway. Warren Buffett doesn't believe in that. So single shares of Berkshire Hathaway is like $300,000.
Who buys those stocks?
Who buys those stock is the institutionals, rich people, but institutional, like State of California Retirement Fund or Fidelity Magellan Mutual Fund.
But you can buy them in fraction also, right?
Yeah, so they did introduce this B shares, which are fractional shares. Or you can sign up with Robinhood.com. Robinhood allows you to buy fractional shares in any company. Yeah, but Berkshire Hathaway issued a sidecar, BRK, A shares and B shares. B shares are like 1/10 of the A shares, so you can buy that. So this is something about dividend, how that works. The answer is there. Stock rises by the amount of the dividend, and then stock drops by the amount of dividend after the date dividend is given, just we were discussing earlier. If you sell before the record date, so you have to hang on for so many days when dividend is given in the day of record. So this is the period. So this is some of the stocks which paid dividend just for fun. So you notice here, these are the companies, and this is the date the dividend is paid. How much is dividend? 20 cents a share, 55 cents a share, and that tells you the yield, because based on stock price, you can see it ranges anywhere from 1 or 2%, 0.7% to 11%. So a lot of people just focus on dividend paying stocks.
Can you see possibly one or two stocks? I know you don't want anybody to play that game for the heck of it. How the prices have performed historically before the dividend and after the dividend date?
It's a good idea. Let's do that. So when we've been looking at Apple, so let's look at Apple. Just had a dividend they were paid on. Let's look at Apple. Let's see. Mike is very intrigued by this dividend play. Let's take a look. Okay, this is Apple. Dividend date was November 6th, so which was only like a few days ago. So let's go to 1 month chart.
Remember the Mr. Market.
Yeah, Mr. Market knows it all. They already figured it out. You're absolutely right. So 1 month chart. So it was November 6th, was it? Yeah. November 6th. So what happened on November 6th? November 4th. So a lot of people wanted to buy the share probably November 6th right here. So then after they got the dividend date, a lot of people sold. So it went down to 116. So it went from, we can zoom into this, I think. Let's go to full screen. You can share my screen, see my screen, no? Yeah.
Yeah.
So let's see what happens. So November 6th. Okay, we want to go to 1 month chart. And we don't want to see, only want to see Apple. So we don't need to see S&P 500 or Dow Jones Industrial Average. So November was 6th, right here. So you notice this was the dividend date. Price did drop by, there was a $4 difference between this date and the price drop. So it didn't drop a little bit, not a lot, but there was a clear drop after dividend date. Stock was rising. People were trying to buy the shares probably to get the dividend, got the dividend, sold the shares.
So just let's see, before the dividend, the top price, and then the drop price next day, how much was that, and how much time it took to recover, come back to the normal?
Yeah, in this, Apple is a very highly traded stock, so it didn't take long. You see, it was here at 119. Then on 11th, it went back, recovered in a few days. But Apple is a very popular stock. If you take some not so popular stock, it may be longer.
And,
the
dividend,
right?
Sorry.
These sort of arbitrage opportunities, right? They are in general very hard to find, right? I mean, there are a lot of investors, hedge funds, very capable folks, computers looking at these arbitrage opportunities, and they are very hard to find.
Well, or said another way, there are people much smarter than you and I who are already doing that with algorithms and a nanosecond basis. Don't go there. It's all, game has been figured out by very, very smart computer trying to optimize extra few pennies. So you're not going to be able to win that game.
I don't know if this is true or not, but I heard a few years ago somebody sitting in the market was watching how people were bidding for stocks, and they were buying in the live stocks because their connections to the market was like a nanosecond earlier, and they were buying it and selling it to you.
Yeah,
So
this is Michael Lewis' last book talks about how people were putting fiber optic cable to be 20 millisecond faster than the neighbor. You're absolutely right. So there people are doing that. So don't try to go there.
The term for that is high frequency trading, right? That's becoming very popular.
Yeah, and it's not and Nisar is not a man sitting and doing that. It's a computer sitting and doing
that. Yes, I know. So there are much smarter people sitting in the market who are playing even with the fibers to actually game it.
Okay, so how do you want to do? You basically go to one of these. These are the three safe, large, trusted names: Schwab, Fidelity, and Vanguard. Vanguard specializes in mutual funds and ETFs. Schwab, you can buy individual shares as well as ETF, and everybody else's, not just Schwab things, anybody thinks. And you can walk in physically to Schwab or Fidelity offices. They're all over town, and sit down with someone and say, hey, I want to open an account. It's that simple a conversation. They'll do everything. You can move your IRA from your previous company into a rollover IRA, and then you can learn to play with what we just talked about today. Not complicated. We can literally log in and do that, but I'm sensitive to time. I want to go to the option thingy a little bit. One thing which will be useful to you, something called dollar cost averaging. So for example, should we get into market today? Well, it's hard to know because market is kind of overvalued, a lot of uncertainty because of politics. So a method is called dollar cost averaging. Suppose you have $10,000 to put in the market. Why not buy $2,500 worth every month automatically, give instructions to your, you can automatically set it up that this way you get an average price. If stock price drops, you get more shares. For in this example, you're putting $30 every month. In first month, you bought 1 share. The price dropped to $15, you got 2 shares. Third month dropped again, you got 3 shares now. Then it went up to $30, you got 1 share. So your average will be better than just buying all up front and taking all the risk. So dollar cost averaging is setting up a predetermined interval. So in this case, your average price divided by 6 or $21.66. Average share price will be, if you do that, was $18. So you were better off average cost per share if you did that with dollar cost averaging. You came up at a good price. So this was the whole point, that you could, and I do that all the time, dollar cost averaging, because in a Bitcoin I was buying like this every little bit every month because I don't know what the up and down of that was. So I was able to accumulate.
Is Bitcoin a really, I'm not asking for, but there are a lot of people who are investing in Bitcoin. I don't see any particularly value in Bitcoin, is it?
Yeah, that's a longer discussion, but the short answer is if you need a way to transfer money, and without the cheapest way to transfer money from one country to another is Bitcoin, and it has certain benefits, and there's a scarcity value. There can only be a finite number, I think 21.4 million Bitcoins. And so there's a scarcity value. So it has gone pretty hot. It was down to like few thousand, $2,000-3,000. Now it's up to $18,000-19,000. So that's a long discussion, which I don't want to do in this forum. Okay, so last thing I was going to talk about, how do you buy shares physically? We can log in and actually buy shares today, right now, but I'm a little sensitive to time when I get to the option chapter. So literally, if necessary, I'll show you, you log into an account, and this is where you decide, I want to buy this Apple. This is the date, this is my price. And you can put this is actually for an option I was going to show you. And we'll get to option in a second, but this is how you do it, and we can do it together. So I'm going to get into option now. Any question about index, stock markets, anything else which is we should repeat? Amber is good.
Oh,
Batul?
Yeah, okay, awesome. So yeah, thank you so much for the awesome talk. So I had a quick question. What I wanted to know, so you mentioned about moving averages and other algorithms. So do you have these algorithms in place? Like, did you code them up, or are you using some other third-party software, or do you manually, like, literally go through moving averages of each and every stock that you're interested in?
Short answer is simple. Yahoo. So don't have to be complicated. Yahoo and finance that they have already. So let me show you. So if we go to, this is okay. Let's pick something. Let's say S&P 500, and you want to show moving averages. Somewhere here is moving averages. Okay, so maybe I can do a search here. I will be able to show you anyway. So it's available, it's free. It's either Yahoo Finance or the Google Finance has it. You can just type moving averages and you can see them here. And I should have done that before this thing. I have to look for them where they are. But short answer
also, right,
G?
when you open brokerage account, they have all these tools available.
Okay. Yeah, so I'll be able to show you that too. I'll be able to log into my own brokerage account and share with you this thing.
Sure. So basically what I was trying to ask is that, so are these tools already there?
Yes.
Or I see. So you can just choose like how many companies you want and then put those triggers.
Yeah, you can put those triggers. Yeah, all those things are available. The tools available. I used to subscribe to a charting software.
I see.
Which used to be, it was $30 a month. I stopped doing that now. But yes, they are now available on, if you broker an account, all these come with it.
Okay, cool.
So not a problem.
Awesome.
So,
right. Yeah.
Okay.
Thank you.
Let's go to some of this option. So, because it's been a long time, I want to make sure that you guys can get some rest. In Pakistan, it's even late at night. So you heard a lot of previous talks about options. So I'm not going to repeat what's been said, but let me just cover a couple of basic concepts. Option is a right to buy a block of shares. They come in block of 100. It's called a contract. A contract is a block of 100 shares of a publicly traded company stock at a certain price by a certain date. That's it. It's no more complicated than that. So you can say, I want to have a right to buy 2 contracts of Apple by January 2021 and it'll cost me X dollars. So since in the future, there's a premium, it's called the time premium, because we don't know stock will be high. So people are willing to sell you that right, but they want a certain price for that, selling you that right. As you get closer to the expiry date, the premium goes down because the day of expiry date, there's no premium because today is the last day it expires. If you look something 1 week out, premium is this much. 2 months out is larger. 1 year out, even larger. So this is what happens, that in time value, there's an erosion of that value 2 months later, then get 1 month later, there's no time value because option, the right to buy expires that day. So is that confusing? Ask me now. Anybody except Imran Haji Musa. So over time, you can buy an option. It's called a call option. You can call a stock to buy over the next X days at a certain price. So let's take an example. A put option is opposite of that. It's the opposite of call option. It's a right to sell a block of shares at a given price that you select, called strike price, anytime between now and the given date, the actual expiry date. So call option is a right to buy. A put option is right to sell. So if I'm expecting some stock to go down, let's say Apple, in the next 2-3 months, I can buy a right to sell the shares to you at some price, let's say $120 a share. So then call option is right to buy. So let's take a look, some example. So when you go to your account, this is what this looks like. I'm looking at Apple. It's trading at $119. I did that last weekend, so it's about 120. You can notice here, let's look at the left side. This is the call options. Right to buy the share, how much premium will I pay? So it's $120. So between now and this was a week ago, so this is 1 week premium. Let's look, today's 20th, 21st, yeah. So today, if I go there, it'll be right to buy stock in the week from now at $120. I have to pay somebody $2.24, and I have a right to buy one share at this price. Obviously, I will only pay somebody $2.25 to buy a share because I'm expecting Apple price to be higher than 122. If I believe Apple will be $125, $130, then I want to buy the right to buy the shares at $120 right here. Okay, let's show you more clearly. And we can look at that in real time. If I'm willing to pay somebody this much money, because I believe stock will be higher than, I'm paying somebody, the strike price is $120. I'm paying somebody $2.26. So I have invested, I expect price to be higher than this. Only then I will make this trade. So if I think Apple stock is going to be 125, 130, this is a smart trade. I can buy the share for $120 in the next week or two and pay $2.26 for this privilege. So let me pause here, make sure everybody's with me.
So in other words, what you're kind of betting on, right? You're
It's
saying
kind of
that,
betting, yeah, it's kind of betting.
you're expecting that by that certain day, the price will be higher, but I am paying the premium.
Yeah.
And you have to be really sure that your bet will work, right?
Exactly. So if Apple is $120, so 100 shares, if I wanted to buy, that will be, I need to have $12,000 in my pocket to buy 100 shares of Apple. But suppose I don't have
Naeem Zafar Saab, and not giving into in the Sharia compliance issue, not that, but that still yet it is a gamble. What else is gamble? It's you think that it will be that much. What is that you think based on? And then this price, whatever $120 or whatever was that the premium that we are paying? Who sets that? That's the market sets that. So how is that compared to when you go to casinos and they say, hey, 99.9% return on your investment in striking those things, and that's all calculated. It looks like, because machines are putting casino at the advantage, not at you at the advantage. So nobody has ever become rich gambling, and that's for the same thing it does over there.
No,
okay.
And it's not the same thing. That's my point.
Okay,
there's
go
no
ahead.
casino here. There's nobody saying a price. When I'm buying this option to buy this share, I'm buying it from another person. There's no government involved. There's no casino involved. There's not a betting. Two equal buyers, we could be trading nimbus and say, कि ये शलजम की price ऊपर होने वाली है, अभी बेच दे यार. Is that kind of a transaction? It's between two individuals.
Premium. Who sets the premium price?
No, nobody sets the premium. I keep asking, यार $1 का दे दे यार. You refuse. I say, यार 1.5 का दे दे. चल यार 2 का दे दे. So this, it's not a premium. It's a two people transacting. This was the last price somebody agreed.
Right. So whole chart of premium is available between this price, this price. So computers are assembling that and coming up with that.
Real time. And you can see the difference here. Somebody wanted to buy this right for $2.24. The guy who was willing to sell wanted $2.29. So there's arbitrage of this 5 cents between them. Till they both agree, that will be the new price. Just like buying a stock.
Yeah.
You buy a stock, you're buying from somebody else.
Thank you.
There's no casino involved.
Yeah. So I mean, the casino is not evil anyway, because casino is also a bunch of people. Yeah.
Well, it's a little different. My point is, this is as pure as buying a share, except this is a right to buy a share.
Yeah, right to buy a share at a different date, and it doesn't include a bigger level of speculation. Even buying stock is also a thinking and expecting.
If I can add a couple of comments, right? It's really is the way to look at it is that you're really sort of analyzing the stock, right? The underlying stock, and do you believe in that stock? Let's say fundamentals or technical analysis or whatever, right?
Yeah, yeah.
And with options, all you're doing is you're defining the time frame within which you are saying either it's going to appreciate or go down, right? So really, it's the way to look at is you look at the stock fundamentally, right? Do you believe is the stock going to go down?
Yeah.
Then are you convinced in terms of the time frame within which it's going to go up? Then options gives you much bigger leverage to buy that stock or the right to buy that stock.
So yes, let me add to what Naveed said. There are 2 points to be made here. One point is, it's just like buying a stock with one added component. When you buy a stock, you say it's going to go up or go down based on your analysis. This will be additional component is in what time frame. I can pick a time frame as short as a week or 2 days, or as long as 2 years. That's the additional component. Second point is, which I was going to make here in writing. If I wanted to buy 100 shares of Apple, how much money do I need to have in the bank? Answer is $12,000, $120 a share, 100 shares. I don't have $12,000. I can control 100 shares of Apple with only $226. How? By buying a option to buy 100 shares of Apple with price is only $226 right here. So I can control, this is the second point Naveed made, leverage. This is called leverage. So I don't have to have a lot of money. I can control a lot more shares with very little money. And guess what? If that day comes and stock was at $130, I don't have to come up with $13,000 to buy the shares. I can sell my option to somebody else. So I bought it for $2.26. If stock went to 130, that option would be worth $10. So I can sell it for $10 times 100 shares for $1,000, and my gain on $226 investment is like 300%. I spent only $226 and I got $1,000 back if stock went to 130. So I have leverage. I'm investing so little and I can make a lot more. That's why options are attractive. You can control a large number of shares with much smaller money if you were to buy.
So what happens in case if the price is actually lower than 120?
Then you don't exercise your option. Then you just lost what you premium, which is $226.
You just
which is
lost.
Still much better than lose 226 and lose some bigger amount of money if you bought the shares.
I see.
So I will talk about some attractive way of doing it, but let's understand what options are, which we just sort of looked at. Similarly, these options you can buy, we looked at not just for, here we're looking at for expiring on April 27th, April 20th. You can buy them expiring on December. Every week they expire, all the way into January of 2021. Same share, $120, like we talked about. Now premium, look at that, $17. This is what I mean by time premium, because people believe एक हफ्ते के लिए तो they were willing to pay $2-3. अब 3 महीने में stock can go much higher, they believe. New product will be announced. So the premium to control 100 shares is $17. So this you can go into 2022 even. So you can have a control of 100 or 200 shares of Apple into 2022. Yes, you will pay in this case $17 times one contract, which is 100 share, $1,700. But you are controlling, hoping the stock price of Apple will be something higher than 120. You already paid 17 per share. If it's north of 137, you just made some profit.
And then you don't have to wait for the date to sell it. It's the window you have option to sell in between. So in between, if you see that Apple stocks take a spike and you say, "Ooh, this is just a temporary spike. Let me get off." So you make your money get off.
Absolutely.
And then it can go down.
You have to wait till that day, because if stock price is goes and right here you notice that it's already gone up to 145. Your option price suddenly has gone up to like monthly. You get out of, sell the option to somebody else. Options are trading just like stock freely.
There is no actual stock buying.
It does happen sometime. You can actually buy the shares and hang on to them, or you can sell the option to another buyer if you can find one. So some people do both. I've done both. You can exercise the option, buy the share, hang on to them because you believe, let's just buy at 120. That's a good price.
So what if you decide to hold and not sell it, but then the price goes down?
Yeah.
Right.
Option price or stock price?
Yeah, a stock price.
After you have bought the shares?
For example, yeah, you bought the share or options.
Yeah.
So you made so 120, 140.
Yeah.
And you hold, you don't sell that option.
Yeah, it expires after that date. There's a date, the very explicit date is listed here. Mm-hmm. After that date, after 4:30 Eastern time, the option is worthless. So this is why.
Oh, I see.
You need to make sure that you write down on your calendar when to make sure you don't. I have done that, by the way. I have bought option, forgot to exercise them or sell them, got so busy, and stupid thing expired. So I painfully.
No, I think what he's asking is, and same question is in my mind. Let's say I set an arbitrary price that I buy it for 120 and I pay 225 for the option. So in my mind, I set the price. I say, well, I'm going to make a $5 profit or $7 profit or $10 profit. So let's say the price goes up to 125, 127, 130. So if it's gone up to 127, I say, well, it looks like it's going in the right direction. Do I wait until it goes up to 130? Or 127 comes down to 119? Yeah. So when is the right time to sell it? Is it something you predetermine in your mind that, oh, I just need to make at least $5 on this stock to double my profit? Or
nobody can answer that question. It's your personal.
So it's all win and lose then. I mean, it plays into your psyche whether you set an arbitrary rate or versus.
Yeah, exactly. But like buying, if you bought actual shares of a stock, suppose we are not doing option. Right. When do you sell your shares? I mean, it's your decision based on when you feel you have gained enough. Some people just say, if I make 20%, I'll sell it. That's not my philosophy. I believe in stop loss, a trailing stop loss, which says is that if stock goes anywhere, and my number is 25%, every time it goes to trailing stop loss, then automatically sell it. Which means if I buy a stock here and it's going up, so here I put a stop loss when I bought the stock here. Okay, my stop loss was 25%. So suppose I bought the stock at $100. When so my trailing stop loss is 25%. If it goes to 75, automatically sell it. Stock suppose goes to $200. My trailing stop loss automatically will be 25% less than that. 150, automatically sell it. It goes
so
down.
So you have a discipline you work with, basically.
I have a discipline I work with, yeah. So I will not going to get the highest price, but I have a trailing stop loss, which means it keeps moving it automatically above and above. So stock goes to $500. I'm not selling it. Some people believe you take 20% gain, just sell it. I think that's stupid. Some stock keeps running. So as long as I have a trailing stop loss, which will automatically sell it if it goes below X% below the highest level you have achieved, then you're good. So Fidelity Schwab allows you to set trailing stop losses.
There is a word of caution on that. The trailing stop loss, you should have it at a substantially lower safe level, not a very close safe level, because the market makers see where you are all sitting, and they have the ability. They go and they jink you out. They come and do a little dip, take you out, and then go back for profit making again.
That's why I use 25%. Many people use 5%. 5% is like so little. So market makers seeing all the orders sitting out there, they'll just cash you out. So that's why I use 25%, which is not so. Some people use 5%, 6%, 7%. That's too small. Okay. So put option work the same way. This is Zoom. Zoom was up here $400 some when it came down. So I think I was going to make a point. If you were believing stock is going to go down, you can buy a put option, which will give you a right to sell the stock to somebody else at this price. So stock goes down. Now you can buy it from the market $400, sell it for $430. You get the gain. So don't go to, put works the same way, but I just stick with call. It's easy to understand, easy to do. Let me just finish this talk because you guys have been very patient for 2 hours. Let me finish the talk in 3 minutes. Last talk. and Nasir Siddiqui Saab are joining now. Okay. The safest way when you cannot possibly lose money, that's called writing covered calls. There's no way to lose money. So, which means that you're selling somebody a right to purchase shares at a certain price. You're selling the call option to somebody else. It's like collecting rent on your property. You own a property, you can rent it out. You rent out a room. So imagine you own, let's go back to see how much money you can make. Suppose you were own 200 shares of Apple. You notice here, what is the, my camera is hiding this. What is the premium for selling stock by January at $120? And the answer is, this is the price. So $120. This is the price. $6 approximately. So if you had 200 shares of Apple, you own it, you can sell somebody the right to buy it from you at 120 for $6 a share. How much will they pay you? They'll pay you 6 times 200. You'll get $120. I'm calling it rent because you sold what's called a covered call. You own the shares, you rent somebody, okay, you have a right to buy it from 120. Suppose you even wanted to buy it for higher than 120. So you suppose you do it for, let's say, 125. Then the price is like $3.80. So at 125, you can sell somebody the right to buy. You have 200 shares times 3. Can I round up 390 to $4? Just simple math. So that's somebody paid you $400 rent. But this was 1,200. So somebody paid you. What am I doing? My math is wrong. 800. $4, 200 shares, 800. You collected a rent. Somebody buy the share from you based on right here for $800 rent. 3 things can happen. Stock can go down from 120, 125, stay between 120 and 125, or go to 140, 150. What will happen? In all 3 cases, if the stock goes down, you still own the shares, stock still has went to $100 or $110, you keep the rent you collected, $800. Second scenario, stock stays between 120 and 125. What happens? You keep the rent. Third scenario, stock goes higher. Stock goes to 140. What will happen? This guy will buy from you at 125, 200 shares, plus you keep the $800 rent you collected. Since you bought the shares at 120 or before, you made a small profit of $5 per shares, plus you kept the rent of 800. You cannot lose money. There's no way to lose money.
You actually have to sell the stocks then, right?
Yeah, the guy exercised. He bought the shares from you because he had the right to buy the shares at 125. Stock was at 140, so he exercised his right. He bought the shares from you. All done electronically. You don't have to do anything. So you made, the only thing you lost was the potential profit. If you had not sold the option, you could have sold the share at 140 but there's no way to lose money.
So Naeem Saab, could you please do ROI on this thing?
ROI, I can do some math here, but
yeah.
You had bought
it says $24,000 you blocked in there for how much long time and the potential earning of 800. Is that what it is, right?
So you in this example, you kept it for 2 months because we are selling the option for January 2021. Today is November. So 2 mahine ke andar, first of all, you made $800 rent, the premium you collected, plus either you, and that's it. And then if your shares get sold at 125, you still made the $5 profit per share. Only thing you didn't was the additional profit you could have made.
Sure.
But here's the beauty. You can rent this room for 2 months and make the $800, then do it again in January, then do it again in March, then do it again in April. Check that out. You keep renting the same room, keep collecting the rent. So over the 1 year, you could have done that 6 times.
So if my math is right, it came to about 19%, so 20,
yeah.
20%.
But remember, you keep doing it. You can keep doing it every month. So people, this is called covered writing, covered call. You're selling the right to somebody to buy at a higher price than you bought it, and you can keep repeating this. This is called doing a covered call, selling a covered call. Why is covered? Because your ass is covered. You own the shares. So you have no downside risk. If somebody wants to exercise, here they are. Le ja bhi le ja. So this is the point I'm making, that this is the safest way to make money in stock market if you own the shares.
And you lose the share, you don't lose the money. You still make it.
Yeah, you still make it. You lose the share at a profit. Lose meaning that somebody buys it from you at a profit at a price which you selected.
And the earning was $800 regardless. Is that true?
Yeah, regardless, because you already collected that money. Yeah.
Yeah.
Okay, so question is, why is it so simple? Why doesn't everybody do it?
Need money.
Because you need the initial money to buy those 200 shares. Not everybody has that. But if you own the shares, you should be, it's like if you own the house, you could be renting your extra room every morning, every day on Airbnb and collecting. It's the same concept. So this is the
I have a question, please.
Yeah, Asma.
So a lot of us get stock options in our compensation. So in that way, we own the shares when they're vet. Can we do the call options on that, our stocks?
Only after you exercise that vested shares and own the shares.
Okay.
So you have to pay money to when you own the share and it's a publicly traded company, then yes.
Okay, awesome. Thank you.
Okay.
Just a word thing I would look at is, right, because companies restrict you from doing options trading on your company's shares. So you should check on that.
Check on that. Because
inside trading stuff.
Some companies may restrict you because of insider trading thing, unless you're too junior, but still, it's easy to do in other company. Why do it on your own company?
Exactly. Yeah. So I can just get the stock, I can sell it, buy something else. But the idea is if you are able to own the stock, you want to make money off of it, is what I'm trying to understand.
If you already, it's a select property. If you already own the property, you might as well rent and collect some money. Some people are too lazy to do that, like me. I mean, I have a lot of shit. I don't do covered calls because I'm doing so many other things, but I could. You know, it's the same thing. I have all the kids have gone from the house. I could be renting the room, but yeah, who wants the hassle? So I don't.
Thanks. No, this is very helpful. Thank you.
So now, just to give you an idea, this is the example. I've done the math for you here. So how you make the money. So I've done the math, Mike, which you're trying to do. I'll share the slide, but that's the idea. There was Apple shares, you know, at $4.95 was the option price. So I've done all the math for you. So basically that's the idea, that you can keep doing it. Because what I want to talk about is, I can come back to this slide in a second, but I'm going to share the slide with you. You can study the math yourself. What I want to talk about is something called okay, what was I trying to do? I was showing you, I was showing you the time value of stuff. So मैंने एक हफ्ते पहले किया था ना ये, तो जब बनाई थी slide बनाई थी. So in it, the price option price for a 120 strike price was $1.55. अगर 2 हफ्ते का करो, so it was $2.25. So you can see the time premium. One extra week, people had a higher chance of stock going up, so they were willing a higher premium. If you go 3 weeks, 4 weeks, this number will keep rising. Like we saw for January, it was $6. So this is called covered call. So this is all the math. So with 200 shares, you'll collect $1.55, 300 each week. So between December. So point is that if you own the share, you can keep renting the same room over and over again. So this is how this thing works. What I want to talk about is something called naked calls. That's the last thing I'm going to talk about. Naked call means what if you can sell the covered call for the stock you don't actually own? Do you have to really own the shares? No, you don't really have to. You could sell the call, call it naked call, still collect the premium, the rent, but you don't own it. So think of that. If your neighbor is gone to Hawaii for a month and you start renting his extra room and collect the rent, You could do that, just like that. What can go wrong? Well, what can go wrong is you don't own the shares. So suppose stock goes to $200 and the guy who wants it says, okay, I want to exercise my stock. Give me the stock at 120. But you don't actually own the shares. Now you have to go buy the shares at $200 and sell it to him for 120. This is called naked option. So that's why naked option is more dangerous, because your risk is unlimited. Covered call is the safest option because you own the property. Here you don't own the property, but you're renting it anyway. But the leverage is beautiful. So is there a way to cover your ass? Answer is yes. And just this is a topic for a future talk, but I'm going to give you with the suspense. What you do I have a slide on this? Yeah. Advanced technique. You can buy a leap. Leap is a long-term call option. So suppose I buy a call option to buy the shares in the next 12 months at 120. So I'll pay a rent for that to somebody else, let's say $15 a share. So I'm covered. If stock goes to 200, 300, I can buy it always at that price and then sell it to somebody. Then I keep renting the room every month. This is called straddle and strangles. These are advanced techniques. So you can cover your risk by buying a leap, a long-term call option, while selling naked calls every month, every week. So my point is, you could have a lot of fun with option naked and covered by protecting yourself. Now, this is a more advanced topic, but I just wanted to drop it that it is possible. You don't have to own the shares to do this. That's the safest way. You can also do things like that. I know Imran Haji Musa knows much about this. Imran, do you want to say any parting thoughts on this topic?
No, I think you covered most of it. So I think the basic, what Naeem Saab explained, the covered call and covered puts, the greatest way, because I know that somebody was making a comment saying, what is my ROI? ROI, you are considering $240,000 to $24,000, and then you're trying to calculate 18, 17% ROI. What Naeem Saab is trying to explain is revolutionary. I mean, not revolutionary, but it's a third dimension. That's not that you are spending 24,000 and then you're trying to make something like 10%, 20% on top of it. You already are invested. That's the money you're wasting. I mean, sitting there, that investment is there. Now you're not utilizing it, just hoping that it will go up and up over 10 years, 15 years. Why not make money in the meantime? That's the whole concept about covered calls. And it takes time to sink, but once you know it, it's the best thing, because if nothing else, you're reducing your cost basis on ongoing basis, because every 2 months you are making this call option money. Think about it. If you bought it for $100, now it's $98. Now it's $96. There's another way of thinking.
Yeah, your cost basis keeps going down as you collect the rent.
Correct, exactly. So don't think of it saying, hey, I bought it for $100 and I made 5% or 2% on cover call options. Think of it, this is the stock you wanted to own anyway. It is sitting there doing nothing. Why not make your money that is invested work for you and earn extra money? Yeah. And that's a beautiful concept. And same thing goes into the put options also, but probably for another day.
Yeah. So guys, we covered a lot of stuff. We talked about market, different dynamics. Batul, I know you want to know about those trigger points. I can add those couple of slides when I send it to those moving averages. I was going to log into my Schwab account and do some real-time trading, but we have been on already more than 2 hours. I'm respectful of people like Mozam who are very time constrained to be given this much time of it. So I don't want to push my limit of stay past my welcome. So guys, I hope this triggered a few thoughts in your mind. My whole point is don't be intimidated. Walk into Schwab or a Fidelity, open an account, just play with $1,000. If you only had $1,000, buy S&P 500 and do call dollar cost average over 3 months. So put $250 every month for 3 months, 4 months, you'll have $1,000. That could be starting point. Doesn't have to be complicated.
Naeem, I have a question on options.
Yeah.
Can you hear me?
Yeah.
When do the options expire? You said they're useless after 4:30 p.m.
On the date, listen over here. Look at the dotted line. It tells you.
Right. I know that. I thought they expired at 1 o'clock our time, which is 4 o'clock Eastern.
Pacific, yeah.
Oh, you said 4:30. You said 4:30 Eastern time.
That's what
So that's where.
Yeah. But I could be wrong. It could be 1 o'clock Eastern time. I don't know. It's that day. So whatever you did do the day before.
Right. Because I do all this,
yeah.
And I know they expire. At least that's what my information was. The moment the market closes,
yeah,
there is no after-hour trading on options.
That's correct. That is so that it doesn't market close 4:30 p.m. Eastern time.
No, it closes at 4 o'clock.
Oh, 4 o'clock. Okay, got it. Oh, yeah, you're absolutely right.
Yeah. Okay. All right.
Okay.
Good stuff.
Okay,
I think the last.
And if you want this thing, especially, email me. I'll send you the slides. It's nzafar@gmail. And I hope to see you guys again. We can go deeper into any other topic. Let Mike Zeddy know which topic you want to go deeper into. If not, he's the quarterback. We just listen to him. He do what he tells us to do. So, all right, Gal. See you.
Okay, thank you.
Thank you very much.
Thank you.
Bye.
Thank you.
Thank you.
Thank you.
Thank you very much, Naeem sir.
Yeah, thank you. Zain, you wanted to say something about something? You wanted to make a comment. Do you still want to?
No, I was going to tell about dollar cost averaging, how it works.
Okay.
But some other time.
All right.
Thanks.
Thank you,
Naeem, I had a quick question on the option premium quotes. Can one calculate the probability of reaching the strike price based just on the option premium quotes? I know that in the premium, there's an intrinsic value and a time value.
Yeah.
But I wanted to know what is the probability that the strike price would be reached based on the premiums?
Yeah, so short answer is not to my knowledge, because this is just like a stock. Any stock price, can we predict the stock price? What would it be a week later or 2 weeks later or a month later? The answer is I can't. There are all kinds of big money, computers, algorithms, smart quants do that every single day. And that's how they make money in the hedge funds and whatnot. So we are too small. We just don't know. Don't even try to compute.
Thank you. Yeah.
Okay. I know it's a not satisfactory answer, but that's the only answer.
No, it's good. But, one can
speculate. One can try. Yes.
No, not only that, you can set your own premium. You don't have to accept the premium which is quoted.
Yeah.
So let's say for a call, you're buying a call, let's say $1. You can always set a price and say, no, I want, $1.50. You may get it, may not get it.
Yeah.
It just depends on, how the stock moves.
Yeah, yeah, exactly. So this is basically setting a what they call limit order.
Yes.
You can say that I'm willing to sell this thing for $1.50. Anybody wants to buy, and you wait till somebody hits it, and yes. So this is called limit orders. You can set it up, and that's a good way to buy things. You can pick their own price and see if it ever hits it.
And it's no way anybody is going to buy it before if it beats the market value of it. So people will keep buying it to market. So again, it's the limit thing. When it touches your point, then it'll make it.
Yeah, exactly.